So, how does a massive global company like a truly massive one suffer an 18% drop in operational profit due to currency fluctuations, but then simultaneously report a net income that skyrockets by literally thousands of percent from the previous quarter?
I mean, it sounds totally made up, right?
It really does. But welcome to this deep dive, custom tailored just for you. Today, we are opening the books on the Q1 2026 earnings release of Suzano.
Yeah, and for those who might not track this daily, they're one of the world's absolute largest integrated pulp and paper producers.
Exactly. And our mission today is to decode exactly how a global commodity giant like that navigates, frankly, an incredibly volatile macroeconomic world.
Right, because we're talking about a company that moves millions of tons of pulp across oceans.
Yeah, but at its core, this is really a story about the complex mechanics of global interconnectedness, you know?
Totally. It's
Right.
about how they manage international shipping logistics, how they aggressively mitigate these extreme currency fluctuations.
Oh, the currency stuff is wild. We'll get to that.
Yeah, and how they restructure massive physical supply chains just to produce, everything from cardboard packaging to the tissue in your bathroom.
Right. Earnings reports can sometimes feel like a wall of numbers, but this one, it kind of reads like an economic thriller to me. It's a masterclass in how a business builds financial armor against global chaos.
It really is. And
Yeah.
to truly understand their market position, we have to look way past those top-line revenue numbers.
Right, because the surface numbers don't tell the whole story.
Exactly. The underlying financial mechanisms, the operational restructuring, that's what dictates survival at this scale.
Yeah, so before we look at Suzano's bank account, we need to understand the turbulent world they were selling into during the first quarter of 2026.
Yeah.
Because the macro demand environment was, well, it was heavily fragmented.
Very much so.
Like if we look at China, demand for paper was remarkably robust. Total paper production there actually grew by 14.7% compared to Q1 2025.
Which is a massive jump.
Massive. But then you look at Europe and the dynamic is completely split. Hardwood pulp consumption managed to grow by about 1.7%, while softwood pulp dropped quite sharply, down 8.5%.
Yeah, and that divergence in Europe is actually a perfect indicator of shifting consumer behaviors. Hardwood pulp, particularly the eucalyptus kind that Suzano specializes in, that's primarily utilized for tissue and printing papers.
Okay.
But softwood, which has longer fibers, that gives you the tensile strength needed for heavy-duty packaging. So a sharp drop in softwood demand points toward a real slowdown in industrial manufacturing in the Eurozone.
Right, less stuff being put into cardboard boxes.
Exactly. Meanwhile, China's aggressive 14.7% growth signals this massive post-holiday industrial restocking phase.
And overlaying those regional shifts, we have a highly volatile geopolitical landscape. Suzano's report specifically flags the escalation of tensions between Iran and the United States as a major variable.
Right, which impacts everything.
It does, and I want to be super explicit here. For you listening, our focus is strictly on the balance sheet. We're looking at this purely through the lens of supply chain logistics, ocean freight costs, energy volatility. We're stepping entirely around politics, taking no sides whatsoever, just analyzing the operational impacts as outlined in the report.
Which is exactly how Suzano has to look at it. Purely from an operational standpoint, conflict in that region introduces immense friction into global trade routes.
Okay, let's unpack this, because I'm looking at Suzano's Q1 sales volume of 2,835,000 tons, which, yeah, huge number.
Right.
But it actually represents a 17% drop compared to the previous quarter. So my pushback is, if China's demand spiked 14.7%, why did Suzano's volume drop so much? Is there a structural slowdown we're missing?
It's a great question, but it's actually just a textbook example of industry seasonality.
Oh, really? Not a slowdown.
Right. So Q4 is historically the most aggressive period for global supply chains. Companies are building massive inventory buffers for the end-of-year consumer push, plus the Lunar New Year in Asia.
Ah, right. So they stock up before the holidays.
Exactly. So Q1 naturally sees a deceleration as those inventories are burned down. To accurately gauge the market, you have to look year over year. When we compare Q1 2026 to Q1 2025, Suzano's pulp sales volume actually increased by 7%.
Oh, wow. Okay, so despite the sequential dip, the underlying global demand was structurally stronger than it was a year ago.
Exactly.
Okay, so the volume is fundamentally healthy, even with the logistical friction. But, moving physical volume only matters if the margins hold up when the revenue crosses back over the border.
And that brings us to the currency dynamics.
Yes, this is where the report is just wild. So the Brazilian real had a massive impact on Q1. Over the quarter, the US dollar depreciated by an average of 3% against the real. And compared to Q1 of last year, the dollar dropped a full 10%.
which is huge for an exporter.
Right. Because of this stronger local currency, Suzano's adjusted EBITDA, which is basically their core operational profitability, fell 18% quarter over quarter, down to 4.6 billion reais.
Yeah, that's just straightforward margin compression. Suzano pays its workforce and maintains its mills in Brazilian reais. But pulp is globally traded in U.S. dollars.
Right.
So when the dollar weakens by 10% year over year, every dollar they bring home buys fewer reais to cover those local costs.
So the revenue line shrinks locally, but the costs stay the same.
Exactly. It compresses that EBITDA margin directly.
Oh, okay, that makes sense for operations. But here is the paradox. Their operational profits took a huge hit from the currency shift, but their net income, the absolute bottom line profit, just exploded.
It's pretty counterintuitive.
It really is. They reported a net income of 4.3 billion reais for the first quarter. And to put that in perspective, the previous quarter, it was just 116 million.
Yeah, a massive jump.
So wait, if the stronger real hurt their export earnings, why did their net income skyrocket so much?
If we connect this to the bigger picture, it's entirely driven by the accounting mechanics of their debt. Suzano holds roughly 12.6 billion US dollars worth of foreign currency debt.
Okay.
Because they're a Brazilian entity, their entire balance sheet has to be calculated in Brazilian reais at the end of the quarter. When the US dollar gets weaker, the principal value of that $12.6 billion debt literally shrinks when translated back into reais.
Oh, wow. So it's basically like, let's say you take out a massive mortgage in US dollars, but you live in Brazil and earn reais. If the dollar crashes, suddenly your mortgage looks way smaller on paper.
That's exactly it. It generates this huge non-cash financial gain on the income statement. It artificially inflates the net income figure, totally masking the fact that the actual operational cash was squeezed.
That's fascinating. But honestly, holding 12.6 billion in foreign denominated debt seems incredibly aggressive. Doesn't that expose them to a massive risk? Like if the rail were to suddenly crash, wouldn't that debt just balloon and crush them?
It would if they were a purely domestic company. But remember, 81% of their revenue comes from global exports priced in dollars.
Ah, it's a calculated structural hedge. They match their liabilities to their receivables. If the real crashes and their debt looks larger, their operational margins simultaneously explode because those dollar revenues are suddenly worth way more reais.
That is so smart. Okay, but currency exposure isn't the only risk they're managing. Let's talk about how they handle the energy market volatility from those Middle East tensions we mentioned.
Right, the zero-cost collar hedges.
Yes. So they use these zero-cost collar operations to protect against spikes in oil prices, which is basically like, imagine you're going on a cross-country road trip and you buy an insurance policy that says no matter what happens, you won't pay more than $4 a gallon for gas.
Yeah, you cap your maximum price, but you also set a floor so you don't pay an upfront premium.
Exactly.
Mm.
And by deploying this on Brent crude oil, they generated a positive cash adjustment of 48 million reais in Q1. How exactly did that trade neutralize their physical risk?
Well, Suzano consumes vast amounts of energy, right? Not just in their mills, but the heavy bunker fuel for their cargo ships.
Right. And when tensions rise, oil spikes. Exactly. So they needed cost certainty. They set a strict mathematical ceiling on Brent crude. When the actual spot price of oil broke through that ceiling during the quarter, the financial institutions holding the other side of that trade had to pay Suzano the difference.
Wow, so that 48 million raise wasn't just them gambling on the stock market.
No, not at all. That cash flows straight back into the company to explicitly pay for the higher diesel and shipping fuel costs they were facing in the real world.
They synthetically capped their physical inflation.
Precisely.
Man, that's just a brilliant layer of financial armor. But here's where it gets really interesting. Because all the hedges in the world only protect you so much. Eventually, you have to physically harvest the trees and make the pulp right.
You do. You have to get your hands dirty.
And their cost management on the ground was incredible. Their pulp production cash cost, excluding scheduled downtimes, was 802 reais per ton. Year over year, that physical cash cost actually decreased by 7%.
Which is huge in an environment still fighting inflation.
Exactly. How did they drive physical costs down by 7%?
Well, part of it was the currency dynamic we just talked about. The weaker U.S. dollar meant imported inputs, like the caustic soda they use for bleaching the pulp, were cheaper to buy in local terms.
Okay, that makes sense.
But the truly impressive part was an aggressive supply chain restructuring.
Right. The biological acid exchange. This was one of the most compelling things in the report. Suzano paid a second installment of 439 million raise in a deal with Eldorado Brazil Cellulose. They basically swapped a biological asset equivalent to 18 million cubic meters of standing wood in Mato Grosso do Sul.
The scale of that is just hard to fathom.
It is. I mean, 18 million cubic meters of wood isn't just inventory. That's the equivalent of trading an entire living ecosystem. You don't spend hundreds of millions just to get different trees.
No.
This has to be about transportation logistics, right?
What's fascinating here is how macro-level financial strategy literally meets the dirt road.
Yeah.
You're exactly right. The report refers to it as achieving a shorter average supply radius.
Okay, so moving the forest closer to the mill?
Yes. In forestry, the largest variable cost after growing the tree is hauling it. When you load a tree onto a heavy-duty logging truck, that truck burns massive amounts of diesel, needs constant maintenance, requires skilled labor.
Right.
If your forest is 150 kilometers away, you pay for 150 kilometers of fuel and wear and tear for every single load, plus the empty trip back.
So by doing this massive swap with Eldorado, they traded land to consolidate their forestry footprint right next to their own mills.
Exactly. They reorganized the geographic map of their raw materials. They might shave 40 or 50 kilometers off their average supply radius. You multiply that by thousands of truck trips, moving millions of tons of wood. The reduction in diesel and fleet depreciation is astronomical.
Literally saving millions just by optimizing geometry.
Exactly. It fundamentally resets their baseline cost per ton.
So with costs aggressively managed and risks hedged, where are they putting all this cash flow to ensure they dominate the future? Their capital expenditure capex was 3.18 billion reais in Q1.
They are heavily investing in physical growth.
Yeah, specifically a new tissue mill in Aracruz and expanding fluff pulp capacity at their Limeira mill. But if they're already the dominant player in standard pulp, why pivot so hard into tissue and fluff pulp?
This raises an important question about their long-term strategy. Standard hardwood pulp is highly commoditized, right? It goes through extreme price cycles. And a lot of it used to go into printing and writing paper, a sector that is shrinking due to global digitization.
Right, nobody prints anything anymore.
Exactly. But fluff pulp, that's the highly absorbent core material used in diapers, incontinence products, feminine hygiene, and tissue paper is obviously a daily necessity.
So stuff people have to buy no matter what the economy is doing.
Precisely. The demand for those end consumer products is incredibly stable. So by investing billions to convert their raw pulp directly into those higher margin consumer goods, they insulate their revenue from open market volatility.
So what does this all mean for you, the listener? It means the everyday tissue paper or packaging you buy at the store is the end result of these multi-billion real investments and massive logistical maneuvers.
Yeah, it's all connected.
And as they execute this expansion, they're also heavily focused on ESG, environmental, social, and governance. Their MSCI rating was upgraded from BB to BBB. They published a sustainability report following strict GRI, SESB, and TCFD standards.
Right.
Is this just corporate PR, or does this actually impact their operations?
Oh, it's moved way past PR. It's now deeply embedded in their cost of capital. Adhering to the TCFD framework, for instance, requires rigorous mathematical modeling. They have to run complex scenario analyses on how climate shifts, like droughts or rainfall changes, will impact the yield of their eucalyptus clones over a 20-year horizon.
Wow. And how does that affect their actual finances?
A massive percentage of their debt is structured as sustainability-linked bonds. The interest rate they pay is contractually tied to these audited environmental KPIs.
Oh, really?
Yeah. If they reduce water consumption and hit emission targets, their interest rate drops, saving them millions. If they fail, they face severe financial penalties.
So an upgrade in their MSCI rating to BBB actually expands their access to cheaper global capital.
Exactly. Sustainable operations are indistinguishable from core financial strategy now.
That completely flips how you view corporate sustainability. It's not a side project. It's the gateway to the money.
Totally.
If we pull all of this together, the journey of this deep dive has just been incredible. We started with global geopolitical conflicts altering shipping, watched how Suzano defended itself with complex currency and oil hedges,
Yep.
tracked their push to swap 18 million cubic meters of living forest to shorten trucking routes, and ended with their investments in the future of tissue and fluff pulp.
It just shows the immense complexity required to maintain an edge in the modern industrial landscape.
It truly does. And I want to leave you with a final thought to mull over. If a single pulp and paper company's quarterly report reveals this much about the delicate balance of global energy, currency wars, and physical supply chains, how insulated are any of the local, everyday products we buy from the invisible ripple effects of international geopolitics?
It's a great question. We are way more connected than we think.
Absolutely. Thank you for joining us on this exploration. True understanding comes from looking past the headline numbers. We'll catch you on the next deep dive.